All right, today we are cracking the code on the one language every single business on the planet speaks. Nope, it's not English, it's not Mandarin, it's accounting. And you know what? By the time we're done here, you're going to have the key to understanding it.
I want you to think of accounting like a giant ancient tree. It's got all these different branches, one for taxes, another for managing the company on the inside, but the main trunk, that solid core that holds everything together, that's what we're focused on today, financial accounting. It's how a company tells its story to the whole world.
So here's our game plan. First up, we're going to learn the one golden rule that governs everything in accounting. Then we'll see how businesses actually track what happens day to day. After that, we'll get into how to adjust for the tricky realities of timing. And finally, we'll see how all this stuff gets bundled together into the company's official report card. Okay, let's dive right in. Section 1, the core equation of business. Now, everything, and I mean absolutely everything, in financial accounting is built on top of one simple, elegant, and totally unbreakable formula. And this is it, the accounting equation. It basically says what a business owns has to equal what it owes. And look, this isn't just a suggestion, it's like a law of physics for business. It always has to balance, no exceptions. This one simple idea is the bedrock for everything else we're about to do. So let's break that down. What do these words really mean? Well, assets are just the resources a business owns. Think cash in the bank or inventory on a shelf. Liabilities, that's what the business owes to other people, like a bank loan. And equity, that's what the business technically owes back to its owners. It's their slice of the pie. Okay, so we've got our golden rule. But how does that actually work in the real world with all the chaos of daily business? That brings us to Section 2, recording business activity. Let's see how businesses use this equation to keep track of every little thing that happens. It's all done through this process called the accounting cycle. And as you can see, it's a whole series of steps. It starts the second a transaction happens. Then you record it, you check it, and finally, you turn it into those big reports we'll get to later. We're not going to get lost in every single step, don't worry, but this is the roadmap accountants follow to make sure everything stays perfectly in balance. Here's a really simple way to think about our core equation. The stuff that your business owns is equal to the stuff that your business owes. This idea is the heart of a system called double entry accounting. It just means that every single transaction has two sides, a give and a take, that perfectly cancel each other out. It keeps the scales balanced at all times. And what are those two sides called? Debits and credits. Now, I want you to forget everything you think you know about those words, okay? It is way simpler than it sounds. A debit is just the destination where value flows to. A credit is the source where value flows from. That's really it. It's just the story of value moving from the source to a destination. Let's make this real. Our fictional newspaper, Rough Times, sells $40,000 in annual subscriptions, and they get paid in cash. Okay, so where did the value go? It went to the cash account. That's the destination, so we debit it. And where did it come from? It came from subscription revenue. That's the source, so we credit it. Debit on the left, credit on the right, and boom, the transaction is perfectly balanced. So, we recorded the cash. Seems simple enough, right? Well, there's a catch. The moment you get paid isn't always the same moment you actually earn the money. And this brings us to a really important part. Section 3, adjusting for reality. This is where we hit a huge concept, cash versus accrual accounting. Cash accounting is super easy. You just track money when it comes in or goes out. But the pros, they use accrual accounting because it gives a much truer picture of how a company's actually doing. And it's all based on one simple principle. You can only count the money when you actually earned it by delivering the goods. So let's go back to our newspaper, Rough Times. They got all $40,000 in cash right up front. But they've promised to deliver a newspaper every month for a whole year. So here's the big question for you. Did they really earn all of that money on day one? The answer, of course, is no. They can't. They have a promise to keep. They still have to print and deliver all those newspapers. This is where accountants use something called an adjusting entry to fix the books. They move the money they haven't earned yet into a special account called deferred revenue. Just think of it like an IOU. It's a liability because the company owes its customers those future newspapers. It's a promise they have to make good on. And that little adjustment right there, that's what gives us a truly accurate picture of the business. Which brings us to our final section. The big payoff for all this work, the final reports. This is the official scorecard for the entire company. See, all of those balanced and adjusted accounts get summarized into three main reports. You've got the income statement, which tells you if you've made a profit. Then there's the balance sheet, which is basically a snapshot of your accounting equation on one specific day. And finally, the cash flow statement, which shows you exactly where your cash came from and where it went. And this is how it all fits together so beautifully. The accounting system just automatically sorts every single number into the right bucket. All your revenues and expenses, they go to the income statement to show if you're profitable. Your assets, liabilities, and equity, they go on the balance sheet to show your financial health at one moment in time. And every single cash movement gets its own special report. I mean, just think about the journey we just took. We started with one single $40,000 transaction. And by applying these rules, this system, we translated that one little event into a complete and accurate financial picture. That's the real power of accounting. Because at the end of the day, accounting isn't really about crunching numbers. It's about telling a story. The story of a business's health, its performance, its promises. So now that you know the basic grammar of this language, what story are the numbers all around you trying to tell?